Hello everyone. Time really flies. In the blink of an eye, we have already ended the first quarter of 2022. So let's see how the strategies that we teach in our course performed in the first quarter. We will start by getting a sense of the kind of market environment that defined the first quarter of this year. We will then look at how the individual strategies performed under this environment and whether it is in line with the expected behavior. We will then look at the overall multi-strategy performance. The first quarter presented one of the toughest market environments in recent history. Both stocks and bonds went down together, challenging most balanced portfolios out there. The S&P 500, as represented by SPY, rebounded somewhat towards the end of the quarter, but still ended with a loss. US Treasuries lost ground steadily, with the longer maturities losing more. All in, US Treasuries were punished a lot more as compared to stocks in the first quarter. Our risk parity allocation did not change much throughout quarter one, with the bulk allocated to IEF. And since both SPY and IEF went down in Q1, risk parity suffered one of its worst periods in history, and this is within our expectation. For our trend following model, the exposure to stocks was around 110% at the start of the year. It started reducing exposure from the middle of the quarter, but exposure remained between 90 to 100%. Hence, it is to be expected that trend model performance is roughly in line with DIA, which is of course the ETF tracking the Dow Jones Industrial Average. Q1 can be classified as a volatile quarter, as represented by the VIX chart. VIX spent most of the time above 20 and reached almost 40 at one stage before receding back to the 20 handle at the end of the quarter. Our volatility risk premium model was more active during this period, but ultimately navigated this environment pretty well, ending the quarter in the black, outperforming the S&P 500. Sector rotation did well this quarter in terms of asset allocation. It started the year with full allocation to stocks. It then allocated heavily into TLT in February, which turned out to be a good move as long-term treasuries did not go down as much as stocks. It then drastically reduced allocation to TLT in March, just in time to benefit from the strong rebound in stocks. As a result of the timely adjustments, sector rotation outperformed both SPY and TLT for Q1. The combined multi-strategy portfolio outperformed S&P 500 slightly for Q1, although it's still slightly negative for the first quarter. However, the multi-strategy portfolio did not have to suffer as much drawdown as the S&P 500. This is the resilient nature of the multi-strategy portfolio on display. In summary, the first quarter of this year is challenging for risk parity because both stocks and bonds went down together. However, sector rotation and especially volatility trading helped to stabilize the multi-strategy portfolio. Overall, the multi-strategy portfolio did better than SPY and was more resilient on the downside. This is in line with our expectations. Okay, so this is how our models performed in Q1 of 2022. Thank you for listening.